Hello guys, welcome back to Startup Detective. Hong Kong and the UAE are the world's most dynamic business and financial hubs. Both jurisdictions are famous for their pro-business environments, strategic locations, and low tax rates. But as global tax transparency tightens, how do their corporate tax systems stack up? If you are an entrepreneur or a multinational corporation deciding where to plant your flag, choosing between these two involves more than just looking at the headline tax rates. Today, we'll break down their core tax mechanics, analyze the advantages and disadvantages of each, and help you determine which jurisdiction best aligns with your business goals. Let's start with Hong Kong. Hong Kong operates on a territorial tax system. This means that only profits arising in or derived from Hong Kong are taxable. If your company generates revenue overseas, it can often be legally exempt from Hong Kong profits tax. Hong Kong applies a two-tiered profits tax rate for corporations, 8.25% on the first 2 million Hong Kong dollars in assessable profits, 16.5% on any profits exceeding 2 million Hong Kong dollars. An important advantage of Hong Kong is that there are no VAT or GST, no capital gains tax, and no withholding tax on dividends or interest. This makes the local tax structure remarkably simple and excellent for trading and holding companies. However, there are distinct disadvantages. To claim the territorial exemption for offshore profits, you must meet rigorous compliance standards set by the Inland Revenue Department, IRD. You must keep immaculate records, such as document every transaction, email trails, and shipping documents, which prove that your management and operations executed outside Hong Kong. Failing to substantiate your offshore claim can lead to your profits being fully taxed. Now, let's look at the UAE. The UAE introduced a federal corporate tax framework. The standard rate is 9% on taxable profits exceeding 375,000 dirhams. Profits up to this threshold are taxed at 0%. The biggest advantage in the UAE lies within its free zones. Companies operating in a designated free zone that meets specific economic substance requirements can enjoy a 0% corporate tax rate on qualifying income. Furthermore, the UAE boasts zero personal income tax and no withholding taxes, making it a powerful magnet for founders and executives. However, there are notable disadvantages. Unlike Hong Kong, the UAE implements a 5% VAT, which requires additional administrative and management costs. Additionally, to maintain the 0% free zone rate, businesses must strictly adhere to the UAE's economic substance regulations, meaning you usually need a physical footprint and actual employees in the country, rather than just a virtual office address. Let's compare their pros and cons side by side. Hong Kong pros: territorial tax system, potential for 0% tax on purely offshore-sourced income. No VAT, lower administrative and management costs compared to the UAE. No physical setup, Hong Kong company can be managed remotely. Physical establishment is not required to obtain a 0% tax offshore claim. Asian market gateway, ideal if your operations are focused on the Chinese mainland and the broader Asia-Pacific region. Hong Kong cons: stringent offshore claim. Getting offshore claims approved by the IRD is not automatic. It usually requires completing a detailed supplementary questionnaire issued by the IRD and providing proof and related documents if necessary. Higher headline rate if it fails to comply with offshore claim status. The profits are taxed according to the standard rate up to 8.25% and 16.5%. UAE pros: favorable rates, 0% on profits up to 375,000 dirhams, and a low 9% rate thereafter. Global access, excellent gateway for the Middle East, Africa, and Europe. UAE cons: requires physical footprint. According to economic substance rules, a physical setup of the company is required to prove real, tangible operational substance in the country to qualify for the 0% free zone rate exemptions. VAT compliance. The 5% VAT creates an additional compliance burden for businesses operating onshore or within standard free zones. So, how do you choose? Choosing between Hong Kong and the UAE depends entirely on your business model and target markets. If your business involves e-commerce, trading, consulting, or digital services where you deal directly with customers without entering Hong Kong, or if you want to avoid VAT and physical setup, Hong Kong remains a popular choice, a globally trusted, reputable jurisdiction with a simple tax system. However, if your business targets the MENA or European regions and you want to scale up while benefiting from a 9% federal tax rate or 0% in a qualifying free zone, the UAE is an incredibly attractive option. Finally, always ensure to consult with a certified, reputable corporate service provider before making a final corporate structuring decision. Like Get Started HK, they can provide you a bundle service of Hong Kong company incorporation, advisory, accounting, auditing services, and offshore status claims. That's it for today. Thanks for watching. Remember to do CLS, comments, like, and share. If you would like to know more tips about company formation service, subscribe to our channel and stay tuned for our next video. Bye!